Most retail traders have a common problem. They enter the market too late. But why does this happen? It's not necessarily because they are wrong about the market direction. It's because they chase the price. When they see a big green candle, they panic and jump in, thinking they are missing the move. This is the definition of FOMO, fear of missing out. Professional traders do the exact opposite. They don't chase the market. They let the market come to them. Instead of buying at the top of a breakout, they stay patient and wait for pullbacks. They understand that a breakout is just the beginning of a story. To enter a high probability trade, you need a pullback, structure, and most importantly, confirmation. In this masterclass, I'm going to show you exactly how to trade pullbacks with structure, patience, and precision. We will cover the two most reliable pullback strategies in existence, the break and retest and the trendline bounce. I will also explain the liquidity sweep logic that the big institutions use to trap retail traders. Ready to stop chasing and start trading like a pro? Let's begin. Strategy has honed, the break and retest logic. Let's start with the first pullback strategy, the break and retest. This is a simple but incredibly powerful way to trade with clarity instead of emotion. Many traders see a price break, a support or resistance level, and they buy or sell immediately. This is a mistake because that breakout could be a trap designed to grab liquidity before reversing. By waiting for a retest, you are staying patient and allowing the price to return to that broken level to confirm it. This confirmation step is your filter. It helps you avoid those deadly false breakouts and gives you a much more structured and confident entry point. Think of it as the market giving you a second chance to enter at a better price. The psychology behind the scenes. Why does the price pull back? When price breaks above a major resistance, it's a sign that buyers are strong. However, markets never move in a straight line. As price rises, early buyers who entered near the bottom start taking profits. This profit-taking creates temporary selling pressure, causing the price to dip. Retailers see this dip and think the trend is over, but smart money sees this as an opportunity. They wait for the price to hit the previous resistance, which has now flipped into support. If that level holds and price shows rejection, it confirms that the bulls are back in control. This is the change of character we look for. Case study: XAU, USD, and the range breakout. Let's walk through the process step by step with a real example. Look at this XAU USD chart. First, we identify a clear key level where the price has reacted multiple times in the past. Strong levels matter. Weak levels tend to fail. Here, we have a clear support zone. Notice how the price eventually breaks below this level with a strong bearish candle. When the breakout happens, you do nothing. You don't chase the move. You wait. As the price pulls back toward the broken support, you observe how it behaves. Your goal is simple. Confirm that the previous support is now acting as new resistance. If price reaches the level and rejects it with clear price action like a bearish pin bar or a rejection wick, that is your confirmation. In a range-bound market, this is even more critical. In a range, price bounces back and forth between support and resistance with no clear trend. This is where most traders lose money by getting caught in liquidity sweeps. When price finally breaks out of the range, remember, the breakout is not the entry, the retest is. Wait for the market to respect the new boundary before putting your capital at risk. Strategy #2, the Trendline Bounce Masterclass. Now, let's move on to the second pullback strategy, the Trendline Bounce. A trendline is a simple but effective tool that helps you visualize the market direction. It is drawn by connecting swing highs or swing lows. Its purpose is not to predict where the price will go, but to provide a structural guide for where pullbacks are likely to end. To draw a valid trendline, you must follow these professional rules. Rule Hasson: a trendline needs confirmation. You need at least 2 clear touch points to draw the line. The more times the price reacts to the line, the more relevant and strong it becomes. But remember, more touches don't guarantee it will hold forever. A trendline is a tool, not a promise. Rule #2: markets are not perfect. Trends are rarely clean or smooth. Price might briefly break a trend line, then close back inside, or it might spike through it to grab liquidity. This doesn't mean the trend line is useless. It means you must read the price behavior around the zone, not just the line itself. Rule #3. Think in zones, not exact lines. Price will often react slightly before or slightly after touching your line. Focus on the reaction zone. Rule #4. Never force a trend line. If you have to move your line around or ignore major price swings just to make it fit, it doesn't belong on your chart. A forced trend line gives you false confidence and leads to bad trades. Draw it logically based on natural price structure, or don't draw it at all. Advanced Confluence. Gold analysis. Let's apply the trendline bounce strategy to a real-world scenario on XAU/USD. Gold. Using a 5-minute chart, the market is clearly trending higher, making higher highs and higher lows. We connect the swing lows to draw our trend line. We are waiting for a pullback. When gold pulls back to our line, we don't just buy. We look for multi-timeframe alignment. We zoom out to the 1-hour chart to see the bigger picture. On the 1-hour chart, we notice a liquidity sweep. Price briefly broke below a support area, then closed back above it. This tells us that higher timeframe buyers are active. This is our confluence. When the lower timeframe, min, and higher timeframe, 1H, align, you have a powerhouse setup. The execution. On the 5-minute chart, as price hits the trend line, we see a bullish engulfing candle. This is our entry signal. We place our stop loss slightly below the trend line or the recent swing low to avoid being stopped out by minor noise. Our take profit is set at the next key resistance level, aiming for a minimum 2-to-1 reward-to-risk ratio. As you can see, gold respected the trend line and the momentum resumed perfectly. Conclusion: the path to precision. Trading pullbacks is about mastery of patience. You are letting the impatient traders get trapped while you wait for the market to prove its next move to you. Whether it's a break and retest or a trendline bounce, the secret is the same. Wait for the retest, wait for the confirmation candle, and always check your higher timeframes. These two strategies are powerful additions to any trading plan. But remember, they work best when structure, price action, and context are all aligned. You aren't guessing, you are reacting to clear market behavior. Keep practicing these setups on your charts until they become second nature. If you found this video helpful and you want to dive deeper into professional trading techniques, don't forget to like, subscribe, and hit the notification bell. I read every comment, so let me know what you want to see next. Thank you for watching, stay disciplined, and I will see you in the next lesson.